Hey guys, I want to welcome you to Joshua. Joshua has been my accountant since I was 25, so it's been a while. He started with my first business until then, and he's so amazing that even with my business partner, when we ended up like moving on and selling a company, ended up actually retaining his business, like ended up using Joshua as his accountant still. So it's really interesting. He's an amazing person. Trust him. And he has this funny way of presenting and giving analogies that are not boring. So take it on, Josh.
Thanks for joining us, guys. I warned Tanya that I'm an accountant and a dad, so it's not going to be too funny because I got kind of two strikes against me there. But we got to make it as light as we can. And I don't know who's seen Juliana's presentation, but I like how she said that if anybody wants to just interrupt, I see some of you have your mic buttons off. But if you want to put them on and just interrupt, including you, Tanya, feel free to interrupt at any time. So I'm not going to spend too much time talking about us. Tanya already kind of introduced us, so we've been doing this for a while. It's more about me. I've been doing this for a long time too. We've got a large practice. We've got a broad experience. So again, it's really not supposed to be about me. So I'm going to move on. All right, so I guess we could start here, and this part I'm going to make kind of brief too. But one thing I'll start with the cartoon on the left is it's not always fun. Some of the advice I give because it's not fun work, and not everybody wants to hear what I have to tell them. I tell people I'm still looking for the doctor that tells me to eat macaroni and cheese and hamburgers. But unfortunately, they just kind of tell me to do the right thing and eat vegetables and stuff. So I'll move on from there. In terms of the purpose of today too is I have so many clients that they wind up making mistakes and getting penalties and not knowing things. And I try to assume that everybody knows nothing, and I try to tell them as much as we can and warn them as much as we can. But I'm not your mom, so I can't call every single client at every single deadline. A lot of it has to be on you. You guys got to invest in a calendar and make sure that you're on top of things yourself. I guess that goes with everything. So I'm gonna move ahead now, and we'll start with number 10. All right. So number 10, selecting the wrong business formation. I think there's different entity types for different businesses. It depends if you're looking to raise venture capital. A lot of venture capitalists don't like S corporations. On the flip side, you're going to have with a limited liability company, you're going to have additional burden. The reason being is the Social Security tax is substantial on a limited liability company, especially with a lot of Tanya's businesses, these really starting out businesses. That first 100,000 of profit, it's just nasty. Especially, how many people here live in New York City? Okay, raise your hands. Okay, well, if you're not living in New York City or not, if your business not in New York City, at least you're going to save some taxes. But in terms of that first 100,000 you make, you're paying 15% Social Security tax before you've paid any income tax. Depending on your whatever deductions you have, kids and whatnot, you could add 100,000, you're easily paying federal income tax of 25%. How about New York State? Anybody here? Can you raise your hand if you're in New York State? Juliana, I know you're in New York. I thought you were in New York State last I checked. Okay. So you're going to wind up paying close to 7% for New York State. So let's add it up. You got 25% for Social Security tax. 15% for Social Security tax, 25% for federal income tax, 7% for state income tax. If you're in the city, you got another 3%. Talking close to 50%. So you make an extra dollar, half of that goes to the government. So that's one of the big advantages of forming an S corporation is the savings on that Social Security tax. A lot of small businesses like doing it for that. There's also, in the real world, you have the audit factor. The IRS loves auditing Schedule Cs, which is your sole proprietorship, which is your single member LLC. So you really need to you really need to sit with a professional, not just the attorneys. They can help you with the liability side, but you really need to speak to a tax professional before before you make that decision. And even if you've already made that decision, sometimes there's elections you could do to change how your entity is set up. If you're a single member LLC, there's an election you can make to be treated as a corporation, and then another election to be treated as an S corporation. All right, so we're going to move on. All right, business expenses versus personal expenses. This is a big one. First of all, the IRS is going to frown on you cutting and paying any personal expenses out of your business account. Even vice versa, it's not ideal, because if you're paying for a business expense out of your personal account, it's going to make them wonder if you're doing the opposite as well. It is kind of against the law to do it as well. But if you ever wind up having a problem with the government, they're going to frown on that, and it's going to raise doubt. You never want to be in that position in an audit, even if you were honest. If you're paying things out of the wrong accounts, it's going to create problems for you. It's also going to create a bookkeeping headache for you as well, trying to distinguish what's personal and what's business, and categorizing it the right way. It's costing you more time, which is going to eventually cost you more money. Either you're doing it yourself or you're paying somebody to do it. That's a big problem. If you're not sure if you could deduct something, call your professional. If it's a gray area, there's some latitude in terms of some people, meals and entertainment. They want to deduct every single meal. You have to have a business purpose to that. So I'd warn everybody just to make sure that you're careful with that, and just to make sure that everything's coming out of the right accounts. The other thing is too, in terms of reviewing your financial statements, if it's not coming out of the right account and you're including these personal expenses on your financial statements, it's going to skew your financial statements. It's going to be a lot harder for you to read them. All right, I'll move on. 8, not reconciling your accounts on a regular basis. This is a popular one. A lot of people use QuickBooks. They understand that they'll reconcile their bank accounts, but a lot of them don't understand that you should really be reconciling your credit card accounts as well. With your credit card, some people will make a journal entry. It depends on how many transactions you have, but the purpose of the reconciliation is to basically help guarantee. It's a control. It helps guarantee the integrity of your financial numbers. If you make a mistake, the reconciliation is one of the tools that you have to make sure that mistake is caught. The other advantage of the reconciliation is it's a second review of where your money's going as well. It's an opportunity for you to get a little intimate with your numbers if you're doing it yourself. If you're not doing it yourself, if you're outsourcing it, that's fine, but then you have to pay a little bit more attention to what you're doing as well with your expenses also. So this is a big one. I challenge everybody to make sure that you reconcile through June. A lot of people like to do it like 2 days before they have their tax appointment or 2 days before the deadline. And I don't recommend doing your homework the night before class like that. You're asking for problems. So sometimes people have problems with the reconciliation. I'll plug away again too. You could always contact your professional to get some help. Don't just, QuickBooks, for example, has an option to allow you to make an adjustment, and some people they'll make, oh, I'm off by $100,000. Oh, it's okay. QuickBooks allows me to make an adjustment. That's not what it's meant for. If it's immaterial, which means if it's modest, a few dollars, fine. Because by now we're looking for a few dollars. So you could go ahead and move on from there. All right. This is a great one. Missing important deadlines. A lot of the penalties that the IRS institutes they're really bad. They're bad because you get no benefit by that dollar spent. And some people have a good excuse for not paying their taxes, which is fine. Biggest number one reason why they didn't pay their taxes, well, they didn't have the money. Okay, if you don't have the money, that's fine, but that shouldn't prevent you from filing your taxes. The penalties for not filing your taxes, they're literally 10 times higher than the penalties for not paying your taxes. And for example, late filing penalties for personal income taxes are 5% per month. That's opposed to 0.5% per month for not paying your taxes. So if you don't have the money, file anyway. Make arrangements to pay your taxes. Make arrangements to pay your taxes either with a payment plan or some other means. There's a lot of options out there. Another big penalty that I hate is the late filing penalty for partnerships and corporations. It's gone up. So I believe it's a couple $100 per owner per month. And the sad thing about that is there's really no, not just for the Fed, there's a state penalty as well, per owner per month. I think the state of New York is about $50 per owner per month. You get no benefit for that money that you're laying out. There's no reason to do that. The other problem is you can't make the excuse that you didn't have the money to pay the taxes on a corporate or partnership return. Most of these pass-through entities like partnerships, there's no money due with the return. So it's either laziness or possibly you didn't have the money to pay your tax accountant or pay the money to do it yourself. But you got to balance off the thousands of dollars in penalties that you're going to pay with not coming up with the money or making the time to file your taxes. So you really be familiar with what deadlines you have. That also goes for payroll tax. That goes for sales tax. You're getting no benefit from these penalties, so you really have to be on top of that. Don't expect your accountant to send you a reminder. It's really it's ultimately up to you. We try to send multiple reminders. They get lost. They don't get it. They go in people's junk box. So again, it's ultimately up to you guys to make sure that you're on top of your deadlines. Okay, here's another big one. Reviewing your financial statements on a regular basis. I'll start with that one. You can't really plan your business and manage your business. A lot of people, they go to the idea is that they just focus on trying to make the money, and then at the end of the day, they hope they have enough money left to maybe pay their rent and maybe buy food. You can't run a business that way. You have to be, if you're steering a ship, you want to know before you hit the iceberg that you should be turning the ship. So at least on a monthly basis at a minimum, or even a quarterly basis, you got to review your financial statements. You're going to do that to see if the integrity of the statements are right. You're going to do that to compare your revenue with the prior period, with the prior month, with the year-to-date from the prior year. You're going to review your expenses. Does something seem irregular? Does it not seem consistent? Are you familiar with your expenses? Do you know how much money you're laying out? That all has to get done on a regular basis. And Tanya mentioned before, well, a lot of people don't know what they're looking at or what to look for because we're not accountants. If you can't do it yourself, speak with a professional. But at a minimum, you should be doing it some yourself. So you should be doing it yourself just to have an idea of what's going in and out of your business. This is your business. You're cutting the checks for the most part, and you're swiping the credit card. If you're not reviewing what you're doing, it's a little bit harder for you to be knowledgeable and be accountable, and to see if you're making profits. Lots of times you don't know. Lots of things can skew a financial statement. You're charging things, and you're not recording things properly. So that you really got to get into the habit. And you're small. A lot of these businesses may be small now, but they're not. The idea is that they're not always going to be small. You have to get into the good habits now while your business is manageable. And I know it's hard because you're all wearing 10 hats if you're a small business as well. Another thing is there's nothing wrong with making money. It's just bad to get surprises. So there's nothing worse than a client comes in and he finds out he has this great amount of profit and they're kind of all excited, and then they didn't know that they made this much money. Sometimes they'll take distributions and they spend it. And the number one question I get too is if I made all this money, where did it go? So we're always trying to reconcile that for our customers. But again, you have to know, you have to plan, you have to see, if you see where your profits are, call up your professional, call up your accountant, say, I'm a little bit concerned, I'm having a great year. What can I do to help this? What can I do to mitigate my burden? You have to stay on top of that. This way you don't get surprises. You could also be penalized for owing money by April 15th. The safe harbor provisions that could help you avoid that. We'll get into that a little bit later, but that's huge. Do you understand the difference between accrual and cash? I don't know. I'm sure some of you do. Maybe some of you don't. It's important for you to understand when you're trying to make financial decisions and management decisions based on your sales, for example. It's not just important when you actually collected the money. It's important when you earn the money. Reviewing both reports can give you a better picture. Sometimes you could have timing differences based on a big payment coming in. That can skew a report, so you should be reviewing both reports. Accrual for management purposes, cash more for tax purposes. Now, another big one I want to get into is are you managing your cash flow properly? Businesses first starting out are often struggling to pay the bills. So certain things you could finance, certain things you can't. Typically, your phone bill, your electric bill, typically you're not going to finance that. So if you have a large purchase, that's something that you want to entertain. You also should be entertaining. I recommend for every business to look into a business line of credit. It'll provide the liquidity you need in a hard time, and it could also be an oh shit fund in case things don't go right. The problem is you don't have when you need it, you can't get it. So when times are good, you fill out the application and you get the line of credit. A lot of these banks are providing these line of credits without any no cost. There's no fees to get them. So there's really very little reason not to get these. If you're a homeowner, I strongly recommend the line of credit. Personally, that's a personal kind of oh shit fund. Okay. Maintaining contemporaneous books and records. So what does contemporaneous mean? It means you're supposed to do it as you go along. According to the IRS, you have till the filing date of your deadline. So you're going out on a business meal. You're supposed to do the people, place, and purpose of that business meal. Don't wait 8 months to write down the people, place, and purpose. If you go on a business meal, because you're never going to remember, and you're going to be fudging things. And the IRS doesn't like that. They're going to look. And there was a recent tax court decision on somebody. He wrote on like every single business meal, he wrote business meeting with the same pen, and it looked like he did it all at the last minute. It wasn't done as they went, and they disallowed everything. You have to keep the IRS insists you keep a diary of your expenses. You have to basically show the business purpose to every expense. You can't assume, well, I use my credit card. The IRS isn't going to assume that just because you use your business credit card, even if it seems like, a business type expense, Staples office supply, for example. You could buy popcorn there. You could buy school supplies for your kid. You could buy toilet paper there. There's plenty of personal expenses you could have at Staples. If you don't have the receipt, IRS doesn't have to allow that expense. So get an accordion file, hold on to your receipts, and make sure, and make sure that you're keeping organized with them. This way, in case you do have a problem, you're able to provide them. It's a good business habit anyway for you to be tracking your expenses. That goes for your travel as well. The IRS is particularly sensitive about travel, auto expenses. If you're traveling places, you have to keep a log. You should be recording your odometer readings on your car. You should be recording the purpose of the travel as well. Get accounting software. There's a lot of people, you try to do it in Excel. It's really not the best tool for the job. It's a lot of opportunities to make mistakes. You could use, there's other softwares out there besides QuickBooks if you're more comfortable with them, or you're thrifty, I'll say, and that's fine as long as the reports are useful and as long as you could print the reports and share them with your professional, or you can use them yourself. Again, we said save the, like I said before, save your receipts, please. They'll come in handy in case you need them later. This is the modest one. Withdrawing cash from the ATM. What happens is when you have an audit, the problem with drawing cash from an ATM, especially if you have a Department of Labor audit, is they're going to think that you're paying payroll with that. It's a lot more difficult to prove these cash expenses. Granted, you could have receipts, but a lot of people will take money out of their ATM and they'll say, well, Josh, I had to live. It's going to be a lot easier if you have to live, write yourself a check, cash the check. Don't take a withdrawal from the ATM, especially, God forbid, you're taking out $600 every Friday out of the ATM. Even if you're legitimately using that to go party every Friday night, I was going to say, come on, $600 every week from an ATM. Let's be real, that's payroll. And then you're going to wind up with other problems too, because the burden is going to be on you to prove that it wasn't payroll. And how do you prove that? You're going to be able to justify where you use that money. It's difficult. You never want to be in that position. So I definitely shy away from taking the cash from the ATM to do business. Okay, move on. This is a big one. I don't know how many of you guys did form S corporations or have elected to be treated as an S corporations. If you do, you have to be on payroll. When you file an S election, they're going to send you a form that says, we understand we've approved your election to be treated as an S corporation. I would like to take this opportunity to remind you, you have to be on payroll. It's a pain because you got to either pay for payroll service or you got to do the payroll tax returns yourself, but unfortunately it's necessary. If you don't do it, first of all, you won't be paying into Social Security. Second of all, you're going to piss the IRS off because you haven't paid into Social Security. They want their money. Third of all, you're gonna piss off Department of Labor because they're not collecting their unemployment insurance. So it's unfortunate, but you do have to do it and take reasonable compensation. If you're a doctor, you can't be paying yourself minimum wage. You should be paying. I could argue that you could pay yourself very little. I can't argue that you should pay yourself zero. It's just not reasonable. People ask me, oh, what if I can't afford to pay myself? IRS doesn't care. If you're doing work for a corporation, it's a separate legal entity. They want you to pay yourself. So you got to make sure you do that. And distributions are not payroll. You have to actually pay yourself a salary. Not making estimated payments throughout the year. This is a big one too. A big adjustment for when people start their business is that they're so used to the taxes getting taken out that they don't have the discipline to actually put the money aside and send it to the government. I always ask clients if they have a fish tank. The funny thing with fish in a fish tank is that no matter how big the tank you have, the fish, they use the whole tank. And that's kind of like people in their paychecks. When you're a business owner and you get $1,000, you have $1,000 of profit, or you take $1,000 a week of distributions, that's not all your money. Some of that belongs to the government. And so you either get a savings account, put that away, send it quarterly, or figure out some sort of other method. Otherwise, you're borrowing from the government, and you got two big problems, well, three problems. One problem you have is that you're going to pay an estimated tax penalty. There's a safe harbor provision that says if you estimate enough and pay in enough, you're going to, you won't pay that penalty. Second problem you're going to have is that it's actually a red flag for the government, because they're going to say, oh, this guy didn't make any estimated payments. He owes a fortune. I wonder if he cracked around in order to reduce his burden. Third problem you're going to have without making estimated payments is the fact that if you don't have the money to pay your taxes, you're going to wind up owing money, and you're going to wind up paying interest and late payment penalties at that point. And some people fall into the problem, and then you're going to have to, contend with making estimated payments for that year. Plus, you're on a payment plan for the old taxes, so it's a kind of a double whammy that you have to contend with. And if you're not making the estimated payments for the current year and only for the prior year, sometimes you wind up stacking on year after year. And if you don't make estimated payments, government can actually go after you and say, that's enough. We're not going to allow this anymore. We're not going to give you a payment plan. We're going to instruct your vendors just to pay the government. Number one, don't be shy. Call your accountant. Your accountant loves talking with you during the year, especially after tax season. That's an opportunity for them to make contact with you and see how you're doing. It's going to allow you not to have any surprises. I like the fall meetings are really good because that'll give you, if you do anticipate owing money, first of all, you'll have 6 months to pay it. So it's September, you'll have till April to pay it. Another advantage is you could do you could plan for the end of the year to try to mitigate the tax burden. If maybe there's a major purchase you can make, maybe there's certain retirement plans that you can look into. There's other, that's a great time to plan. But if depending on any of your business is doing all year is fine too. That'll help you. Like I said, that's going to help you to make sure your books are in order. Also, you could do a little cleanup. Your accountant might be able to spot things that you didn't know. Don't be shy. If you're ever going to make any kind of big decision, make sure that you call. Make sure that you call your tax professional. Make sure you sit with them as well. I know it's not all fun, but it's important if you're serious about it, being a business owner. Got a bonus: premature distributions from a retirement account. I've got a sign in my office. It says, please don't say you took money out of a retirement account. And if you did, don't tell me you paid the taxes already, because it's never enough. Depending on how much you take out, it could cost you half of what you take out. So people call me luckily people call me all the time. They say, Josh, I got a call 2 days ago. Josh, planning on taking 30 grand out. I was going to do my kitchen. I don't know where the money's going to go. I don't know where else to get the money from. I got, a long time before I have to retire. And I have to tell the client, well, as long as you're comfortable with the government getting half of that money, because that's what it's going to cost you. It could cost you 25% for the income tax, could cost, or more, 10% for the penalty, 7% for the state income tax. And then you could lose out on other certain benefits when you break certain thresholds. You could lose child tax credit, you could lose education credits. Costs you half of what you take out. It's terrible. And sometimes what they'll do is they'll withhold 10 or 20%, and they think they're fine. Come to see me, find out it costs them another 10 grand at the end of the year. It's a train wreck. It's one of the least fun parts of my job is telling people that they owe money, especially when it's a surprise. So don't be one of those people, please. Some other compliance-related issues. At some point, you may look into hiring an employee. You got to make sure you have workers' comp and disability. It's nastiest for you guys. I don't think anybody here is a contractor, but like in New York State, for example, the penalties are horrendous for not having workers' comp and disability. And it's pathetic because if you're working in an office, these policies are dirt cheap because you're not going to get hurt working in an office, but the laws are made to protect roofers and people who work underwater. So they're going to charge you, they could charge you $200 a day or more for not having this coverage, and you find out 6 months later. So people wind up getting bills for $20,000, $30,000, and they had no idea. Meanwhile, if they only spent a few $100s on an insurance policy, they would have avoided this completely. So make sure you're familiar with your state comp laws, your state disability laws. These are cheap policies for you guys, unless you're in construction. Make sure you get them. It's not fun getting a $30,000 penalty notice in the mail. Believe me. Like we said before, get the disability, get the workers' comp. Those are the big ones. Disability covers you if you're hurt or if you're pregnant. These policies are cheap because they don't give much benefit, but the penalties are nasty. While we're on compliance, make sure you're familiar with your health insurance laws too. New York State just came out with a new Paid Leave Act law. So you got to have, if you ever wind up getting any employees, you You got to make sure that you have coverage for that as well. You're allowed to take it's allowed to be covered by your employees, the expense. However, what's it called? It's your responsibility to hold their job for them while they go out for 2 or 3 months, depending on what year it is, and make sure that they have their job when they get back. Otherwise, you can get sued. Biennial, this is a real minor one. If you formed an entity in New York or wherever state you are, you got to pay a biennial fee. It's like $9. While we're at it, I was going to warn you, if you get other notices, there's a lot of scams out there. There's one compliance notice for $120. That's a scam. Don't pay it. But the biennial fee, you do have to pay. You don't get reminders. You have to go to New York State Department of State's website and register with them for them to email you a reminder. So if you want to keep the valid status of your entity, you want to make sure you do that. Here's a big one. Proper tax forms for independent contractors, huge issue. A lot of especially small businesses, they figure, oh, I'll just give them a 1099. I don't have to worry about this one. I don't have to worry about paying them payroll and Social Security tax and comp. I don't know if I get into this later, but make sure that you're classifying them right. If they're employees, pay them as employees. You don't want problems. If you're paying anybody over $600, generally, especially for service, generally you're going to have to give them a 1099, have them fill out a W-9 before you pay them. Because once you pay them, they're not as quick to give you back. They're not as quick to give you back that form. That means if you pay an LLC, you pay an LLP, you pay an individual, the penalties used to be $50. Penalties are now $500 if you don't issue a 1099 when you're supposed to. It wasn't worth it for them before to issue the penalties because the penalty wasn't high enough. They're starting to do it now, so don't make that mistake. I think this is going to be the last one. This may not apply to many people here, but if you're certain services, repairs, maintenance in New York or wherever state you are, check into it. You're going to need to collect sales tax. Make sure you do it if you're required to. It's kind of nasty if you forget to collect sales tax, because then it's going to be your responsibility to cough up the money that you should have collected. I think that's it, right, Len? I guess we'll open this up to questions and answers, guys.
Awesome. Does anyone have questions? I know I learned a bunch of new stuff.
I think you got all your mic buttons are on the off position. If you do have any questions, guys, you can feel free to bang them out.
Hi, this is Shane.
Hi, Shane.
Hey, great presentation. I just had a quick question about
Sure.
You said you should not be paying yourself distributions. You should be paying yourself payroll. Is that for if you only have an S corp? But what if you have an LLC? Are distributions fine, or should you set up payroll for your LLC if you're a two-member LLC?
A two-member LLC. If you're a two-member, you haven't made the election to be treated as a corporation, right?
No.
Two-member LLC is not required to be on payroll. You're going to be okay with that. You could take distributions. An S corporation could also take distributions, but you have to have some salary. You're supposed to pay yourself reasonable compensation. For an LLC, taking distributions are fine. You should be tracking what you're paying yourselves. You do have to, because you do have to report it at the end of the year. And again, with the LLCs, be cognizant that you got to pay, generally, if you're both active, you have to pay self-employment tax, which is nasty on those earnings. So in addition to any income tax, before you take any deductions on the profits, you're going to be paying 15% your Social Security tax on that first. It's about $120,000 each. That's 15%. So on the first 120, you're giving 18 grand over to the government before you've paid income tax. So as long as you're being treated as a partnership and you've made no elections, you would not be required to have payroll.
Okay. Thank you.
Sure.
Hey guys, this is Don.
Hi, Don.
Thank you, Josh. Actually, I have a question. So this is the first year of my company, and should I wait until the end of the year to pay the taxes, or I have to pay quarterly?
Glad you asked. Were you an employee the year before?
I'm sorry.
Were you on a W-2 before this year?
Right now, I'm still on W-2, and I still have my company as well. So like both.
Okay. We kind of discussed this before, but you want to look at the actual tax that you had in 2016. So say your tax was $10,000. You made 100, your tax was 10. You need to give them at least $11,000 in 2017 in order to avoid an estimated tax penalty. What state are you in, Don?
I'm in Texas.
Oh, well, that's great. No state income tax. That's super. Well, so that will apply to the Fed. You have to look at the tax on your 2016 return, and you need to make sure that either you're getting withholdings that are going to compensate for that, to give you at least 110% of the prior. In some cases, it's 100%. There's other safe harbor provisions as well that could say 90% of the current year's tax. But you want to give, try to have in your W. So you're still getting a W-2 from another company, Don?
Yes. Uh-huh.
You could adjust your withholdings, especially if you have profits. That'll avoid the penalties. So that's the first thing. The second thing you have to contend with is surprise you owe money. So as long as you're saving the money on the side from your profits, you should be okay. But you do want to make sure you avoid that penalty. I hate paying penalties. So make sure that you got to look at the tax and make sure you have enough withholdings. You could adjust your withholdings from that W-2 to compensate if you like.
Right. But I mean, the point is, I can wait until the end of the year, right? I don't have to pay quarterly.
As long as you pay in from your W-2, 110% of the prior tax, you can make $1 million on your own and cut a check for $300,000 on April 15th without a penalty.
I see. Thank you, sir. Thank you.
No problem, Don. Victoria, you're being kind of quiet over there. You got any questions?
Hang on. Oh, hi. Sorry, I hid my screen because I was having lunch. I don't have any questions, actually. You just sort of validated a lot of things because I had originally started as an S Corp, changed it over to an LLC because of the payroll and a couple other reasons, and we've been paying quarterly. So I got my software, I got all my stuff. Now I just need a little more revenue.
Okay. That's great. That's great. Well, I'm glad. Hopefully you're getting into some of these good habits as well while you're small.
Yep.
That's great.
This was great.
I'm glad you enjoyed it, Victoria.
Anyone else? Because I know you guys have tons of questions. One of the big ones is a lot of, and I've seen a lot of members where they've done really well and they haven't paid any taxes, right? And let's say they haven't haven't reviewed their statements. Let's say they're paying themselves out not to give taxes. But what would you suggest for them to hold on to, like at least the minimum? Be like, okay, if I'm making this much, I should put this much in taxes, right? Because a lot of them probably are thinking, I can write off a bunch of things.
Yes. Yeah. I usually say that, it's a ballpark, you could say a third until you start making more money. A third, you could say, well, Josh, is that a third of your revenue or a third of your profit? It depends on your business. Some businesses are heavy with the expenses. I have I've seen 2 distributors in the last 2 days. They'll make 10 million in sales and they'll make like 50,000 in profit. So you can't really go off of that example, but bare minimum, you want to be putting away a third to 40%, especially these LLCs where you got to pay for that Social Security tax. With the LLCs, say even more, even at least 40%, if not more. With S Corp, you could be you have a little bit less, but minimum of 40%, Tanya, if you're an LLC. Because that Social Security tax is just nasty, unfortunately. People aren't used to giving half of what they make to the government.
Got it. Eric, I know you were on mute before, so let's go for it.
Well, the last thing you said, shit. But Josh, what about if I'm paying somebody a referral fee? How does that work? How do I record that income referral? Is it like I'm paying somebody like with the W-2?
That's a good question. Where do you live, Eric?
New York.
So where's your business, I should say?
New York.
Great. I've dealt with that with Department of Labor. I think you have to be careful with that. It really, I think it depends. You have to make sure you keep very good records. First of all, if it truly is just a referral fee and there's really no relationship with that person, the one thing you got to worry about is either IRS or Department of Labor saying that, well, this looks like a salesman. You're paying this guy, I don't know. How often are you paying the guy? Oh, girl.
Over the course of like 2-3 months, like two or three payments.
I assume he works somewhere else, or she works somewhere else.
Yeah, they have their own company,
Okay.
but they have paid me for work also.
Are you paying the company or are you paying the individual?
Company.
You're a lot safer paying the company. Is it an LLC or a corp?
I am not clear right now.
Okay. You might want to find out. If it is an LLC, I would definitely give them a 1099. New York's, you're not in the construction business, right?
No, not yet at least.
Good. Outside of construction, if you pay a corporation, it's very difficult for the government to argue that this was an employee if you're actually paying the corporation. So if you're paying an LLC, even with an LLC, it'd be difficult for them. If it's an LLC, you got to give them a 1099, but if you're giving somebody a referral fee, I would write referral fee on the memo or the check as well. The other thing you have to be cognizant of, though, too, is workers' comp. Workers' comp does tend to make you pay tax on subcontractors, not tax. They'll make you pay premiums on subcontractors. So you want to make sure that they understand that this person's not there's no exposure here, and that this is really just a referral fee. It wouldn't be a terrible idea if you could have some kind of an agreement in writing. It would be ideal. But if not, I would just keep very careful track. You want to keep track of the related sale, too, that they gave you, too, in case you ever have an issue, especially Department of Labor. But whoever you have an issue with, you want to be able to document what you were doing so no one can ever argue it's an employee.
Okay, got it. And thank you for that.
Sure.
Other question is, so a lot of the time I get paid through PayPal. So if I get paid through PayPal, it's going into my personal account, and then I'm going to put it into my business account. I could obviously change that. I just sets a couple of things up. But how do I manage the money on paper? So if I'm getting the money, should I put it directly into my business account? But when I want to actually use that money, how do I do that so that it's so it looks convenient when I'm doing my accounting for later?
I'm delighted you brought this up, Eric. I had an audit on a situation like this, but I've had actually a lot of problems. eBay, people eBaying, PayPal relating to their business. Eric, I don't know if you could, what's the call? If you see that mic button off, but is the PayPal tied to your social, or is it tied to the tax ID of the business? Sorry, Eric, I don't. Oh, Eric, go ahead.
Right now, it's right now the PayPal. It's not. It's not attached to my social or my business. So I imagine. I don't know if that's good or bad, but I could set it up like that easily.
Where do you live, Eric?
New York State.
PayPal never asked for some kind of a tax ID when you set up the account?
I set up this account maybe 18 years ago. Like maybe 15 years ago.
I'm really, no, that's fine, but I wasn't aware that they didn't. The problem I'm having is people are, even as a hobby, are selling stuff on eBay, and they're getting letters from the IRS saying you didn't report this income. So I would check with PayPal to see what ID they have, because if they are sending it to your social, you may not get it for a year or two, but you could wind up getting a love letter from the government because they don't know what it is, especially if it's a lot of money. If it's more than a few $1,000, I would definitely make sure that you speak with PayPal and make sure they have the tax ID for your business. And then you want to link the PayPal to your business. In the interim, you could contribute, you could put that money in the business. And if it's an actual sale from a customer, I would treat it just like any other money that came from a customer. And when you deposit that money into your bank account, into your business bank account from your personal bank account, be the equivalent of like somebody gave you personally cash to pay off a business invoice. You would put that money into your business. When you need money back from the business, cut yourself a distribution. Assuming are you a corporation, Eric?
No, LLC.
Okay. You don't have, assuming you're not being taxed as a corporation, you can cut yourself a check then for a distribution. But I would put the money in first, record it so you have a good paper trail, put the money in your business, satisfy any invoice, or record a sales receipt, record the sale that way, then take the money back out if you want any, just like you would any other distribution.
Okay, got it. So then let's say I bank with one bank and I could transfer money between my business and my personal. Is that like writing a check? Is it the same thing? Is that good?
Yeah, I'm okay with that as long as you're keeping a good record. What's it called? When you hopefully you keep a good record. You should, as long as you record that you received the payment and record the sale and record the payment from the sale. I'm pretty comfortable with that. I'm okay with that. But as again, I think that was the second or third slide. The reason why you don't want to be in too much of a habit of that is because if you do ever have a problem with the IRS, what they're going to say is this: okay, he said he did the right thing. He took $30,000 into his personal account. There were several transactions, but then he deposited into his business and he reported on his income tax. And you might think, oh, well, I'm good then, right? Because I was honest, I put it in, I paid the taxes on it. So, but with the way an IRS auditor is going to look at it, they're going to say, so I see he makes a habit of taking the money into his personal account first and then putting it into the business. I wonder if he forgot to put any of those deposits that he got personally into the business. I wonder if he got it all. Again, you're bringing up the doubt with an auditor. Rather than be in that position, you never have to explain anything. The less explaining you do, the better. You never have to explain anything if you put the money directly into your business. So you're going to want to see if you could switch that with PayPal. That goes again, treat business with business and personal with personal. Plus, you're going to avoid that headache I said before of getting a CP 2000 from the IRS saying why you didn't report this income personally. By the way, last thing, you should find out if they did report it. They reported it in, say, 2016. They're starting to send letters, or even 17. You may want to show it on the return and then just wash it out of your return. Basically, you'll have a line item on your tax return that says revenues reported on single member LLC. Well, are you a single member, by the way?
Yes.
If you're a single member LLC, you might be okay anyway because you're going to show that on your disregarded entity. You may be showing that on your 1040 anyway, so that may not be as big a deal in terms of getting a love letter. Assuming you reported the income, you shouldn't be getting a love letter. You just really want to make sure that you're taking care of it from the perspective of not bringing any doubt in case you have a problem in terms of whether you kept your personal and your business.
Okay, cool. And I like how you say love letter. It's hilarious.
Nobody likes those letters. Even if you got a letter from the government saying that there was a mistake and you're getting money, just the fact that you got that letter from the IRS, nobody likes that. Nobody likes it. They're not
I got it.
Hey, Josh.
Yes.
Thank you very much for this presentation. It's been terrific. I did have a question for you. It's more procedural. So I take credit cards, not a lot of them, but I do take them occasionally. And I'm always struggling with, is there a better way to record the credit card processing fee? Right now, it's a little clunky for me. Right now, I use QuickBooks and I show that an invoice has been paid for the entire amount. And then I go into the account where that money goes and I show in my case, I use SquareUp. So I show a Square Up processing fee, and I have to find that fee against what was paid, put in that amount. Is there a better way to do this?
So you said you're using Square?
I'm using Square. That's my credit card processor.
Is it funding the next day?
Yeah, it's generally funding the next day, next business day.
Yeah. Good question. I mean, is the fee consistent?
Well, it's not, because it depends on the amount paid. I think it's like 3.5% or 3.1% plus 15 cents for the transaction. Now, if I did a lot of these, I would probably use something different. But because it's so few, it's not. I looked into it. It's not worth the hassle of dealing with some of these other. There's certain minimums you have to hit. I tend not to want to take credit cards. I'd rather have someone pay with a check.
Yeah, no, I understand. Some people have to worry about chargebacks with the cards too. But so you're saying if you swipe $100, 97 shows up on your bank account? Is that how it works?
Yeah, in my case, I'm keying it in, into a terminal, so I'm not swiping. But yeah, if I swipe, $500, whatever, 500 minus 3.5% plus 15 cents is what actually goes in. So sometimes, if I don't do it right away, it's just, I can find the information on Square Up. They make it a little difficult, but you can find the amount, and then I'm entering into the same account a debit for that fee. It's clunky. I was just wondering if there's a better way to do this, or if what I'm doing is really the only way.
You're using QuickBooks, did you say?
Yes.
Yeah, I mean, I know some people, have you looked into trying to automate the process and seeing if you can link that up with Square? It's a pretty big vendor. I would think there might be a way that you might be able to streamline it a little bit that way. You can also download it. Okay? Are you downloading transactions from Square?
No, I'm big into automation. I haven't touched in this area. By the way, I'm not using the online QuickBooks. I'm using a standalone copy because I'm too cheap to want to pay them every month, because I pay everybody everything every month, and I'm just sick of it.
I don't blame you. I don't blame you.
I figure I could get away with the 2015 software. I'll change it in another year. I hang on to about 3 years and then I upgrade.
Yeah, we use it for about 5. We use the desktop in my office too, and we keep them about 5 years. So I know what you're saying. It's a different interface with the online edition too, but I don't think that would stop you from possibly looking at downloading the transactions and see if you could streamline it that way. You should check with QuickBooks, check with Square, and see if there's a way for you to automatically download the transactions from Square, and then you can match them. That might save you a couple minutes, and that might make it a little bit easier for you, and maybe prevent you from having some problems with it as well. That would probably be my advice. If you're not doing too many transactions, it shouldn't be that painful for you.
It's not. I try to reconcile every week, so I usually catch things before things go amiss. If you ever miss that week, though, boy, you could be in for trouble.
Oh yeah, it's not fun playing catch up. Even when you're small, clients can make a real big mess out of that QuickBooks file very quickly.
Yeah, especially if they don't pay the entire amount right away, and let me pay you $400, and I'll send the other $300 in 5 weeks. That kind of stuff.
It's a hassle. That brings up another quick good point too. Is a very common mistake I see in QuickBooks is people receive payments and then they don't apply it to invoices. I don't know how they do that, but if you look at a cash basis report balance sheet, sometimes you'll notice a negative amount in your AR, and that's kind of an indicator that you have invoices and payments not being applied to those invoices. I see it all the time. So there's an open invoice report you could run when you see the negatives. It's always good to make sure that you do wind up eventually applying the payments to those invoices. Otherwise, your financial statement's going to be screwed up.
Yeah. One last question.
Sure.
Is it a 7-year look back on things? I've got, folders now that are just about on that. I got some from 2007. Do I only need to hang on to things for 7 years and I can trash the rest, or do I have to hang on to everything?
That as a general rule for individuals, it's generally 7 years with certain exceptions. Stocks, you purchase your house. Business owners, you got to be a little bit more careful though, because there's certain things you could have leasehold improvements with 15 years, with 15-year depreciation. 7 years generally okay, but unfortunately with the business, some of the if you're trying to determine your basis, what if you're going to sell your business? That could become an issue where they may want to look at your old tax returns. With a business, I hesitate to even have people throw them out. Unfortunately, what you could do is scan everything. You want to keep it somewhere, keep it somewhere secure online. Put it on jump drive, whatever you got to do. But unfortunately, with businesses, I tend to be a little bit more cautious with what's thrown out. You're going to sell them. Even there's even certain credits. There's a research credit out there. People have asked for stuff back from 10, 15 years ago when they've applied for that credit. So unfortunately, with the business, you got to hold on to the records a little bit longer. In terms of receipts, you could get rid of those after 7 years.
Okay. Receipts and any other paperwork that would support, yes, I did this work for this particular individual. Here's all I could get rid of that?
Yeah, like I said, as a general rule, that's fine.
Okay, yeah. If it's scanning, tax returns, that's a no-brainer. I do that anyway.
Yes.
But if it's all the other stuff, if I can get rid of all the other stuff.
Major improvements, leasehold improvements, you should hold on to those until the lease is up.
But I can scan it. I can scan it.
Yeah,
though. It doesn't have to be hard copy.
Copies are fine.
All right, great. Thank you.
Sure.
Great. So we have 3 minutes for last question. So let's
keep
going. Shane.
So I have one question and one other point. First, the other point on what Jonathan just said. I have QuickBooks Online, and we just had the same issue. And so what we did was, client paid us $3,000. It came into our bank 2,000 and change, and so we just attached it onto connected it to that particular invoice, and then the difference we just put as a negative, whatever the balance was, and just put that as a bank charge for processing fees. So that's how we do it. Is that fine?
That could kind of work. The only thing is if any customer ever asks for an invoice later and they're going to wind up seeing that, I don't really think it's any of their business to know what you're getting charged or whatnot. But that works. That's a good workaround.
Okay, cool. And then as far as, because I definitely don't keep track of invoices for meals and all that fun stuff. If I take a picture of it and save that with my QuickBooks, is that fine, or do I need to actually have the physical hard copy?
Yeah, pictures are fine. Copies are fine.
Cool.
Awesome. Thank you so much, Joshua, for your time and your funny PowerPoint. That was awesome. And guys, he's available. If you have any questions, email him. He's amazing. Like I said, he's my accountant, so I was so glad that he took the time, especially now it's not busy season, not tax season. So super excited. Thank you, guys. Thank you, Josh.
Thank you.
Thank you.
All right.
Thanks, everybody. Hope you have fun.